Hey everyone, my name's Nicole Aliev, and my guest today is Brian Foss from First Home Mortgage. Brian is the branch manager here in Frederick, and somebody I can truly say that I really rely on both for information as well as for getting mortgages for my clients. So, Brian, welcome.
Yeah, thank you, Nicole.
Today, Brian and I are going to talk about something which impacts at least 52% of the population, which is divorce. And what we are going to discuss is how divorce settlement considerations relate to home financing, because many people don't realize all the different things that can happen during a divorce and after divorce, even during the case of separation, where it can ultimately affect your ability to be a homeowner going forward for several years. But before we do that, we're in a very interesting real estate market at the moment here in Frederick. And in fact, I would say broader than that, in Maryland, certainly, and along the East Coast, where because of the lack of inventory, there is a very hot seller's market. And so I just wanted to get a quick update from Brian as to what's going on the mortgage side and what he's seeing and what advice he can give. So Brian, tell me about what you're experiencing at the moment.
Yeah, thanks again, Nicole. Yeah, I think one of the things that we're very pleased with in the current market is interest rates. We would not have anticipated seeing rates in the high twos, low threes at this time, but for loan products, that's about where we are. We've seen a pretty significant tick up in refinance activity and purchase activity. And with the purchase activity, I think a really good signal for the state of the market is that in most situations where we have our customers submitting contract offers, they're competing with several other prospective buyers on the same house. So in most situations, we're finding multiple contract offers. And the advice that we're giving to our clients when submitting an offer is to try to be as aggressive as possible, just to have an opportunity to win that bid on the home. The industry itself has regained, I think, some solid footing after some uncertainty when the pandemic effects started to kick in. And there's a little bit more stability in the markets, largely due to the Federal Reserve purchasing significant amounts of mortgage-backed securities. That's helped to stabilize interest rates. But also on the underwriting side, I think the industry has determined kind of a comfort level on some of the standard credit underwriting guidelines, where debt-to-income ratios should be, cash reserves at closing, minimum credit scores. So there's a little bit more consistency there from a loan origination standpoint and understanding credit guidelines. So
if you're putting in an offer and you want to have a strong offer in this market, would you advise your clients to also be putting forward something like a financial disclosure statement or something like that to back it up? Because are the regulations any tighter?
The credit standards are certainly a little bit tighter, for sure. And there are some temporary measures that have been put in place by Fannie Mae, Freddie Mac, and the government agencies, FHA, VA, USDA, that are COVID-related guidelines, especially for self-employed borrowers. They're looking for a little bit more documentation from borrowers, and we're going through a couple of extra steps as we approach a closing date to make sure a borrower is still on their job and that their hours have not been significantly reduced since the application started. And then with self-employed borrowers, we're making sure that their cash flow is still on solid footing.
Okay. Well, so a lot going on. I know that I'm certainly experiencing it, with properties on the market at the moment. Huge interest, a lot of competing offers. It gets quite tough to judge between them, escalation clauses coming through. You know, and even so, just being able to kind of weed through that and, you know, understand truly what is the financial situation of the person who's making that offer can be quite tough. So I
Yeah.
always end up speaking, you know, with the mortgage lender to try and get a deeper impression.
Yeah, and we're finding on the lending side and representing the buyer, I'm receiving more calls from the listing agent when a contract has been offered, just to, you know, determine the viability of the buyer on the property.
Right.
We have you know, pulled credit on the borrower. They're confirming that, verified income with documentation, all of which I think is a good idea, just to take those extra steps to protect, you know, the listing agent seller on the transaction. I mean, one of the bright spots in the market now, just kind of backtracking to where rates are, is affordability. I mean, the affordability and purchasing power of buyers are at historic highs right now, even though prices have ticked up a little bit with where rates are. It's a great opportunity for prospective buyers to jump into the market.
Well, the one worrying thing that I experience is that while you have these buyers, you know, bidding up $20,000-$30,000 in some cases, what's going to happen with the appraisals?
Yeah, yeah, we haven't seen the negative effects of that just yet.
Yeah.
As property values continue to be bid up, if there aren't supporting values in the market, then that could be an issue in the future with the price.
Right.
The demand is certainly there, so it's
demand is there.
It's propping up the values for sure.
Yeah, 633 properties in Frederick, and I think last year this time it was 1,700. So it just goes to show what the demand is. It's huge.
Yeah, that's a pretty good indicator of the seller's market that we're in right now.
There you go. So Brian, let's talk a little more serious on a little more serious subject, although they're both serious, but on divorce and the impact of going through a divorce and having gone through a settlement on a divorce, on applying for a mortgage, because there's several different things that you first off require when you know that somebody is either in going through separation and has applied for a divorce and or after divorce, right? You need a separation agreement and a property separation agreement signed by a judge, right?
That's correct.
And what are some of the implications of those, and or not having those documents?
Yeah, in some situations, if we're entering the picture after a lot of that planning has occurred, we find that, you know, through the advice, you know, the well-meaning advice, obviously, of attorneys, and sometimes by personal choice, you know, there are some accounts, credit accounts, where payment is discontinued until a settlement is reached, and from a credit standpoint and from a lender's viewpoint, missing payments will obviously have an adverse effect on someone's credit score. So if I'm speaking with someone who's in the early stages of separation or divorce, I'll always recommend that they continue making payments. If they're joint accounts, even though it's maybe just on principle, someone prefers not to make that payment, for maintenance of their personal credit score, it's important to continue making those payments. The creditors don't care about a borrower's personal situation if they're in a divorce process. They demand payment, and they are obligated to make file reports to the credit bureaus if payments are late. So it is important to maintain your credit, even on joint accounts. Just make that decision to continue making payments to preserve your credit score. Without that credit score, it ends up costing you significantly more in interest if you even qualify for a mortgage with a lower score. It costs you significantly more over the long term in the higher interest rate that you would pay because of a lower credit score.
And I know that there was a study back in 2012 where they looked at the impact of a dropped or lowered credit score. So the higher you were, where you started off. So say you start off in the 800s, which is an excellent credit score, and you drop down to the 600s, it actually can take you longer to rebuild a good credit score than it would if you were in the lower end to start with.
Yeah, scores always drop much quicker than they rise.
Right.
It can take, just a single late payment on a credit card can drop your score 30 or 40 points.
Wow.
To recover from that drop in the score, it could take 3 to 4 months before you reach that original level. So it is important to maintain that score.
And are there any other things other than, a late payment that could affect the credit score that people, say, going through a divorce might not think of? Like, I don't know, maybe they pay off a car loan, or pay off a loan on something, thinking, well, I'm going to reduce all my debt over here and have zero balance on my credit cards, for instance.
Yeah, I think the best thing to do in that situation is to see if you're in that early stage of the process and it's your intent to purchase a home on your own at some point in the near future. My advice would be to seek out a lending professional as early on in the process as possible, and they'll help advise you on some of the best strategies to maintain your credit, perhaps consolidate debt, paying debts off, paying debts down. I think it would be difficult to try to do that on your own. Even with some of the online resources, it's always my recommendation to talk to your mortgage professional to get that advice from them first.
And in fact, I would recommend that you're doing this before you even begin to go to mediation, or you end up in front of a judge if it's a highly contested divorce, because I think what happens is that people are so caught up in the emotion of the separation and what is going on, that recognizing that there's going to be a longer term implication on some of the things, like where you're going to live, is not something you're perhaps thinking of, because you're dealing with the immediate emotion of what's happening. But the sooner you can get to speak to somebody, you can understand your options as to, can you afford to stay on in the house by yourself? Can you afford to buy your spouse out of the house? Can you afford to actually sell the house and move somewhere else? Would you be eligible for a mortgage? And knowing that up front really helps you when it comes to negotiating with your former spouse, when it comes to mediation, and when it comes to the court. Any thoughts about that?
Yeah, no, I think that should be absolutely part of the planning process. The more knowledge you have and can establish a basis for the strategies that you're going to follow to prepare yourself for the longer term, I think that's important. And the key there is to not hesitate to seek out the advice of professionals in the field in which it would have the most impact on your on the strategies that you develop.
Right. And so Brian, say, one of the other things that I found is that many divorce attorneys, with best intentions for their clients, use appraisals to go forward to determine how to allocate resources and how to ask for resources when it comes to a divorce. But now the appraisal doesn't necessarily account for either title and whatever might be hidden in title, as well as the condition of the home. And so this can also put people in a position where suddenly, they're finding that there might be a HELOC on the house. Can you talk a little bit about some scenarios you've seen where a HELOC might have been abused in a divorce scenario?
Yeah. So that does occur. So a HELOC is a home equity line of credit. Think of it as a credit card with your house being the security against that credit card.
The house is the ATM.
That's right. It's a line of credit. The money's very easily accessible. And just using an example, if you have a $100,000 home equity line of credit with a $10,000 balance on that line of credit, there's still $90,000 in accessible credit that's very easy to withdraw from the account. For a divorce situation, we have seen situations where one of the spouses accesses those funds without informing the other spouse, and it comes as a surprise once title work is pulled, and then there's kind of the attorneys have to revisit that situation to develop whatever the settlement might look like. But yeah, I think just having some awareness on what, if any, mortgages exist on the property, including that HELOC, and perhaps even freezing that account. If you're a joint,
so that is possible.
If you're a joint account holder on that, I think it would be helpful to make that inquiry with the creditor to see if it's possible to freeze that account until negotiations are completed.
Okay, super. And then what happens once a divorce goes through? The ownership moves typically from tenants by the entireties to tenants in common. How might that affect application? If you're applying for a mortgage and you're about to go through that divorce period, either just before the divorce is actually, the judge's gavel comes down, or after it, how might that affect your application?
Yeah, so obviously I'm not an attorney, so wouldn't be able to offer any advice on how title would be held and necessarily what that impact might have on the mortgage. I think if a spouse, one of the spouses, is applying for a new mortgage and a divorce is settled, then they would be purchasing that house as an individual. The departure home, if the departure home is retained by one of the spouses and it happened to be held as tenants by the entirety in the state of Maryland, then we would follow the terms of the separation, on the separation agreement and the divorce decree, and simply title that spouse who's purchasing a new home as a sole owner and individual purchaser. Hope that answers your question.
Right. And talk a little bit about the kind of payment responsibility on a mortgage and home. We mentioned home equity lines, but sometimes you have what I call the in-home spouse. So the spouse who's been awarded custody of the home to live in either for a certain period of time, or potentially they've got a plan to buy out. But that spouse might not be liable for paying the mortgage. Is there anything there that can impact them?
So you're talking about a joint title holder, but someone who may not be on the mortgage, but
exactly
on title. Well, if they would retain the house, if they're not on the mortgage, the lender who holds the mortgage on that property is the controlling interest. If mortgage payments aren't made, even by the spouse who's on title and retaining the home, they have the right to foreclose on that property. So it's in the interest of that person on title who would be retaining the home and living in the home to make sure those mortgage payments are made. Whether they're on that mortgage or not, they'd still have that obligation to make the mortgage because the lender is still expecting payment on that property.
And what would happen if the in-house spouse decides, okay, they want to try and buy out the ex-spouse, the out-of-house spouse? How easy is that, and what are the considerations there?
Yeah, since they would be on title, that would be considered a refinance. And it's just a process. It's a standard mortgage application process where the spouse who would be retaining the property would need to qualify on their own with their own income. We run, a cash flow analysis to make sure they have that cash flow to meet the mortgage obligation as well as any other debts that they might have. So it's a standard process to buy out the ex-spouse. An appraisal would be completed by us as part of that process as well. And then just take over title as an individual and have that mortgage in their name.
And again, just a warning to people, when the appraisal is done, it doesn't always take into account the cost of some of the things that might be needed to maintain the home. So, you're buying out your spouse and you think, okay, well, great, I'm going to stay here. But if you're living in a house with, a 24-year-old roof and it's got a 25-year-old lifespan, you're looking at, potentially $12,000 worth of a roof replacement within the very near future. And you might not have taken that into account. So, yeah. And is there anything about joint accounts without reference to where payment responsibility falls?
Yeah. So I think, are you talking specifically about a mortgage?
Yeah.
So I'm not sure I understand your question. I'm sorry.
Okay. So, say you're applying for a new mortgage and you've had joint accounts, and but you're now looking to either buy out your former spouse who's out of the house, and or just move on and find another property, but you've had a joint account history. Is there anything there that you need to worry about, or are the joint accounts always frozen until such time as the separation is cleared?
Right. I suppose they could be with the credit card company if speaking of revolving type accounts and installment for that matter, but primarily revolving. If you are a joint holder, I suppose you could freeze that account,
right,
to prevent someone from tapping into that credit line unknowingly. The joint accounts, I think, kind of going back to my point earlier, if there are joint accounts, it would be important to continue making payments on those, or at least monitoring payments on those accounts to make sure if the spouse is responsible for making that payment. I think you'd want to make sure those payments are being made on a timely basis, because if they're not, they will affect your personal credit score. And we talked about the damage that can do to you long term, and the cost of interest, and perhaps even not being eligible for financing because your credit score has been reduced by so much. But those joint accounts, obviously would be part of a settlement, and I think it would just behoove an individual to make sure they're aware of what activity is taking place on those joint accounts.
Okay, great. And then lastly, let's talk a little bit about some of the income and assets that you're looking at, and specifically in divorce. One of the big things, or two of the big things, is child support and alimony being two different things. So the child support actually per child worked out by the state of Maryland according to income guidelines, and alimony, which is assessed typically over a period of time, how long you've been married, how long the alimony should continue for, etc. How do you consider or look at those aspects?
Yeah, so if you're receiving alimony pay or child support, there are a couple of things that we look for there. Obviously, the documentation, a court order or a separation agreement and divorce decree referencing what the minimum payment is. But then we also verify receipt of that income. If you are receiving that income and we're using it to qualify you for a mortgage, we'll look for 3 to 6 months of receipt of that income, depending on the loan program. And that's typically through, if it's a court order, we can get that information from the state. If it's direct deposit, obviously we can just get bank statements to see that you've been receiving that money consistently for a 3 to 6 month period. If there are any months that are missed, that can throw a bit of a monkey wrench into us being able to use that income for qualifying purposes. If you're obligated to make payments for child support or alimony, we do count that as a liability. So it can affect your purchasing power, because that's considered a liability, just as a credit card or vehicle loan or mortgage would be considered. And that's in the full amount of the payment.
And is that for both alimony and child support? So if you're paying your child support but you're not paying your alimony, that's also considered to go against you?
That's correct. Yeah, if you're paying the alimony or the child support and you're missing payments, we're still going to count the full payment against you. In cases when we pull a credit report, if a borrower is in arrears in child support payments, for instance, that may appear on a credit report, we will look for that to be brought current, or at least determine what arrangements have been made to bring that account current. Perhaps it might be a situation where the judge has just ordered an increase in child support temporarily to bring it current over a period of time, 12 months, 24 months.
Right. And part of why I'm delving into this one is my own experience was that my ex started paying only just the child support, self-employed individual who, could determine his own pay, so would determine exactly the amount needed to cover the child support, but the alimony was AWOL. So, just determining, does that also then act against them should they be applying for something? So it's not just, because I know that the child support becomes the most important factor for the state.
Yeah, it does. Yeah, the alimony could potentially, I suppose, if there's an arrearage there that's significant, we might want to know what arrangements will be made to bring that account current.
Okay.
Just a doubling up of the minimum requirement, or 1.5 times the minimum requirement. We would likely count that as additional debt against the borrower. Yeah. And if it's income, as mentioned before, if there are untimely payments or missed payments for either child support or alimony, we may have some difficulty in counting that as income for the buyer who's receiving that income.
Super. Brian, any other last thoughts or words of advice to people who are going through a divorce or have just gone through a divorce and are thinking of buying a home?
Yeah, I think just the key point, I think I mentioned it earlier, is just to try to seek the advice of as many professionals as possible early on in the process. They'll help you kind of build a strategy so that you can deal with kind of that painful process as easily as possible.
And what many people don't realize is that, many of these services in a way are free. Sitting down with you and having a discussion about what you can and cannot afford and where your assets are and what would or would not be counted doesn't cost somebody, but it's something that will really enable you, to move forward with good knowledge, to be able to negotiate stuff and hopefully to go forward and buy another home or buy out your existing home.
Completely agree.
Brian, thank you very much for your time today. And if anyone has any questions, Brian, would you like to share your contact info?
Sure. My office phone is 240-474-5407. Feel free to touch base at any time.
And again, that's Brian Foss. He's the manager of First Home Mortgage here in Frederick. And again, my name is Nicole Aliev. I'm with Caris Realty. And should you have any questions, feel free to contact me on 301-305-5169. Stay safe, everyone. And Brian, thank you for your time.
Thanks for having me, Nicole.